The 4 most painful stock market periods in history. Should you hold cash, bonds, or stocks if the 5th one is coming? Hello, members, super savers, and bond course fans. I hope you're healthy and well, despite what we're seeing in the markets and the media headlines currently. Today was not a good day for markets, to put it mildly. It seems economic uncertainty and recession fears are again top of mind for many. And from the communications we receive regularly from some of you in our community, I would say that those worries never really went away. So, on that note, here are the 3 topics that we'll be covering in today's video to help put it all into a bit of perspective. 1. What were the 4 most painful stock market periods in history? 2. Should you hold cash, bonds, or stocks if you fear a recession is coming? And 3. What are some additional words of caution that we'd like to share with you during these uncertain times? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What were the 4 most painful stock market periods in history? As the industry mantra and our disclaimer goes, past performance is not indicative of future results or events. That said, whenever markets start turning south, there is a tendency to look at what's happened before in the hope that history may give us at least a few possible scenarios of how things may turn out this time around. And most of us have probably seen different rankings of bad periods in the stock market that are based on either the severity of the drop or the length of recovery. Meaning that when folks talk about bad periods in the stock market, they often say things like, the market dropped this much, or the recession lasted this long. But that doesn't always tell the full story. For example, relatively short-lived episodes, like the decline of the Dow Jones by 22.6% on Black Monday in 1987, to this day, the largest one-day percentage drop in history, felt very scary to traders who lived through them. But because the markets recovered quickly, memories started fading fast as well. The bear markets that do tend to stick in most people's minds are those that see both steep falls in stock prices and last for a long time, like the Great Depression. Paul Kaplan of Morningstar has developed a method that combines these 2 dimensions: how far the stock prices declined and how long it took for a full recovery to the previous peak, into one single pain index number that makes bear markets comparable. We won't go into details on how Kaplan does it, but in essence, if we look at this Morningstar pain index chart, the steeper the market falls and the longer it takes to get back to the previous peak, the bigger the red area and the bigger the pain. Kaplan is very precise in his work though, and in some cases, he treats, for example, the inflationary bear market of the early 1970s and the inflation, Vietnam, and Watergate bear market of the late 1970s as 2 separate episodes, because there was a short recovery of less than 2 months in between. But as I understand from some of our Diamond NestEgg regulars who lived through this time, these 2 bear markets pretty much felt like one single never-ending slog, just as Marcus and I experienced the internet bubble burst and Great Recession as 2 bear markets combined into a single large one. In fact, in this specific case, even Kaplan refers to these 2 as one here, the lost decade. Although, to be precise as well on our side, it was really a very long decade, as it took 13 years to leave that bear market behind us for good. So, for the purpose of today's video, let's keep everyone and everything on the same page. Besides the lost decade, we've also combined these 2 bear markets into one large, messy 1970s period. And we did the same for the Great Depression, whose after effects lingered around for quite a while and were really only left behind for good after World War II. So, with these adjustments to Kaplan's pain index, let's dive into our Diamond NestEgg ranking of the 4 most painful stock market periods since 1870. Coming in at number 1, By the way, one of those times you don't really want to come in at number one, I would say. So, coming in at number one at a distance is the Great Depression and World War II, which again includes the 1929 crash and Great Depression, the Great Depression and World War II, and the post-war bear market here, with a combined pain index of 188.7. The deepest decline was 79%. It began in August 1929, hit the deepest point in May 1932, and finally recovered for good in October 1950. In total, this most painful stock market period lasted 7,731 days, or 21.2 years. The second most painful period was the messy 1970s, which quite a few of you often talk about on this channel, especially about those 17% APY CDs. In any case, as I mentioned earlier, the messy 1970s period includes both the inflationary bear market and the inflation Vietnam and Watergate period here, with a combined pain index of 94.6. The deepest decline was 51.9%. It began in November 1968, hit this deepest point in September 1974, and finally recovered in June 1983. In total, this second most painful stock market period lasted 5,325 days, or 14.6 years. The third most painful period was World War I and influenza, these two red areas here, with a combined pain index of 89.3. The deepest decline was 51%. It began in June 1911, hit this deepest point in December 1920, and finally recovered in December 1924. In total, this third most painful stock market period lasted 4,932 days, or 13.5 years. The fourth most painful period was the lost decade, which again includes the dot-com bubble burst and the great financial crisis here, with a combined pain index of 85.5. The deepest decline was 54%. It began in August 2000, hit this deepest point in February 2009, and finally recovered in May 2013. In total, this fourth most painful stock market period lasted 4,656 days, or 12.8 years. So, based on Kaplan's calculations, the lost decade was a bit less painful. It has a lower pain index than the World War I and influenza period, because even though the market decline was deeper in the lost decade than in the World War I and influenza period, the downturn lasted a bit shorter over the lost decade than it did over the World War I and influenza period. So, why does this matter, right? Well, because it gives us some good potential insights for the next section of today's video. Should you hold cash, bonds, or stocks if you fear a recession is coming? As I always say, everyone's financial journey is different. So whether you prioritize cash, bonds, or stocks in your portfolio if you fear a recession is coming will depend on your individual circumstances, goals, and expectations. That said, there are some general comments we can offer based on how close to or far away from retirement you might be. Let's start with the first group of savers, those who are several decades away from retirement. And let's take the lost decade as an example. We're dating ourselves a bit here, but Marcus and I both lived through this one, as I touched upon in the previous section. We were in our 20s and 30s back then, still young and fresh in our careers, so to speak, putting money into our retirement accounts with every paycheck, regardless of whether the market went up or down. Yes, it was painful to see our portfolios in the red much of that time, and equally painful to see basically no organic growth in our portfolio for 10 plus years. But we knew that we didn't need that money anytime soon. The retirement was very, very far away. And we also expected that eventually, at some point, the market would go back up again. So we just kept dollar cost averaging into it. And let's just say that this strategy of riding the wave down and then riding the wave all the way back up and beyond, it has worked out okay for us, at least so far. And if you are still many years from retirement, like Marcus and I were when the lost decade hit, then you may want to consider staying invested in the stock market. Because what Kaplan's chart also shows us is that after these long bad periods, when the market goes up eventually, it goes up quickly and steeply, like here and here, as well as here and here. It's basically near impossible to time when these upward spikes will happen. If we take the 95.5 years from August 1st, 1929 to January 31st, 2025, there were a total of 34,882 days, of which approximately 25,624 were days in bear markets. That means that over this 95.5 year period, investors spent 73.5% of their time in bear markets. What this also means is that unless you can figure out in advance the 26.5% of the time during this period when the market was outside of bear market territory and generally skyrocketing upwards, it may be wiser and easier to simply stay invested through the ups and downs if you have a long enough time horizon and risk appetite for it. Otherwise, you may miss the rapid spikes like these here that usually come after a period of bad market patches. So that was the first group of savers, those who are several decades away from retirement. And even though the lost decade was many years ago, this is still the group that Marcus and I would put ourselves in. Let's just say raising 4 kids in this country is not exactly inexpensive. The second group of savers are those who are about to retire or already in retirement. I've said this before, but during highly volatile and uncertain times like these, when some folks may feel that they wake up to a different economic landscape every day, I think it's important for me to say it again. If this is you, and you've been considering going long on bonds, and you have a strong opinion that a recession is near, your best bet may be to start moving some of your cash, money market funds, and T-bills into longer dated bonds to lock in the current rates before they come down. This might especially be something to consider if you're already in retirement and have no appetite to wait out a potential downturn in interest rates. And if you've already been dollar cost averaging into longer dated bonds, you may want to increase the amounts you've been buying because, as we've talked about often on this channel, the classic way to combat a recession is to lower interest rates as a means of encouraging economic growth, meaning that the yield you're currently getting on your T-bills, money market funds, and cash will likely go down. Also keep in mind that even though the Fed generally only controls short-term rates, long-term rates have in the past tended to follow a similar downward path when there is fear of a recession. This means that all else being equal, longer dated bond yields would also likely come down. Again, this is not to say that a recession, or worst case, a multi-year bear market is coming. This is to say that if you fall into this second group of savers and the possibility of a market downturn and its impact on your portfolio is keeping you up at night, then you may want to consider shifting more of your portfolio to longer dated treasuries and CDs so that you can sleep better at night. Not everyone has the same perspective, but in my mind, at a certain stage in your life, a good night's sleep and peace of mind is worth a lot more than the possibility of making a few extra basis points. Whether it's worth it to you, though, is something that only you can decide for yourself. And of course, if you have enough money set aside to cover your regular living expenses and emergencies, no matter what the markets do, then you may also want to just stay put. In this case, you could just continue hanging onto your dry powder, earning the current yields for as long as they last, and possibly scooping up some low-cost equities whenever the market hits a patch that looks like a buying opportunity for you. This applies regardless of whether you fall into the first or the second group of savers. So, on that note, let's move on now to the next section of today's video. What are some additional words of caution that we'd like to share with you during these uncertain times? In times of great unpredictability, when there are so many unknowns, there are at least 3 things to remember. First, stay informed of what's going on, but don't panic. I don't think I'd be overstating this when I say that our Diamond NestEgg community is pretty much filled with savvy, level-headed, and well-informed super savers and investors, because they do often watch videos like this one. But not all videos and stories out there during crazy times will be educational and sober. So if you choose to watch or read financial news that doesn't necessarily lower your blood pressure and anxiety, just remember this: panicking and making rash decisions with your money is almost never a recipe for financial success. Second, always remember the investing mantra: higher risk, higher return. It's been our experience that when markets turn south, some investors get desperate for higher returns. If you come across a fixed income investment, or any investment for that matter, that sounds too good to be true, please do your homework first and make sure that it is a legitimate opportunity that is suitable for your risk-return profile before throwing any of your hard-earned money at it. And third, remain careful of scammers. Scammers have always been around, but it seems that they really are everywhere these days, and even more so when times are volatile, uncertain, and or bad. So if you get an email or a phone call that seems even slightly fishy, please don't respond, and do not click on any links unless you know the sender of an email. So how are you feeling about markets today? Do you fall into this group 1 of savers or this group 2 of savers? And what are you doing with your money right now? Drop a comment below and let me and everyone else know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to build other sources of stable, predictable income in retirement, then check out this video here on our bond courses. And of course, we'll keep watching what's happening in the markets here at Diamond NestEgg and share our perspective with our community of members, super savers, and bond course fans. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And for those of you who subscribe to Your Financial Journey and enjoyed today's video, check out this brand new video here from Caitlin on the 5 worst stock market crashes in history, the companies that didn't make it through, as well as the behemoths that emerged from those times, some of which many of us still hold today in our portfolios. And see you again very soon with more brand new wealth building content for your financial journey.